You've probably heard the saying, time in the market is better than timing the market. But if you're going to spend time in the market, why not structure a position where you can actually get paid for that time? That's exactly what we do with S&P 500 bull put credit spreads. So let's look at a simple example of how this works. In this historical example, with the S&P 500 trading at 5,000 and we're looking 45 days out, instead of needing the market to make a big move higher, we can build a position where the S&P can move higher, sideways, or even fall to a small degree, and we can still make money. So let's look at how this position is built. With the S&P 500 at 5,000, we sell the 4,700 put and collect 65 points. Then, with the same expiry, we buy the 4650 put for 60 points. That gives us a 50-point wide spread and leaves us with a 5-point net credit. Now, the important thing here is the distance we've created between where the market is currently trading and where we've sold the put. And we don't need the S&P to rally. It can move sideways or even come off considerably, and the position can still work for us. This is where the structure becomes very simple. The 4,700 sold put is our line in the sand. As long as the S&P remains comfortably above that level, time is generally working in our favor and the spread should continue losing value. The 4650 put underneath it is there to define our risk. So if we do get a major sell-off, we're not sitting there with unlimited downside. But these numbers really just show us the boundaries of the trade. We're not planning to put the position on and then sit there until expiry, waiting to see whether we make maximum profit or take the maximum loss. How we manage the position is much more important. The spread is 50 points wide and we collect 5 points. So the theoretical maximum profit is 5 points and the theoretical maximum loss is 45 points. Now, if you look at those two numbers in isolation, the risk reward doesn't look particularly attractive, but that misses the point of the strategy. We're selling a spread well below the current market, collecting premium and allowing time decay to work in our favor. We're not looking for one enormous winner. We're looking to consistently put ourselves in a position where the market has room to move and we can still collect premium. And just as importantly, we're not planning to blindly sit there and take the full theoretical loss if the market moves against us. That brings us to the most important part, managing the trade. If the trade works and we've captured most of the available profit, we close it. We don't wait around trying to collect the last dollar. We're generally looking to close the spread early once we've captured around 90% of the premium received. If the market starts moving down towards or through the 4,700 sold strike, now we're paying much closer attention and starting to consider a roll. And if this happens relatively early in the trade and the S&P gets down around that 4650 bought strike, we would normally be looking to close the existing spread and roll it, rather than simply sit there and hope the market comes back. That might mean moving further out in time, moving the strike slower, or a combination of both. Now, that's not a hard and fast rule. It depends on how much time is left, what the spread is trading for, how quickly the market has moved, and what our view of the market is at that time. But the principle is simple. When the trade works, take the premium. When it doesn't, manage the risk early. That's how we use time in the market while getting paid to be there. I'm Steve from Market Edge Australia. If you'd like more information on trading the S&P 500 with credit spreads, or you'd like help using the Interactive Brokers platform to identify and place these type of trades, please get in touch.